The jobs data was weak, but not too weak. Is this the Goldilocks recipe for rate cuts? So here's the quick September jobs week rundown so far. Job openings slid to 7.2 million in July. That's down from 7.4 in June and below flat expectations. Weekly jobless claims climbed to 237,000. That's a step up from last week and topped more flattish forecasts. ADP private employment added 54,000 jobs in August. That's roughly half, though, of the adds in July and a bigger haircut than expected. So the job market is slowing. Everything so far has come in below the prior period and worse than expected. However, it's still not crashing, and that's likely why markets have strongly rallied the past 2 days. So what now? Well, all eyes will be on Friday's jobs report. After last month's massive revisions, investors will be hoping for that just right scenario, a report that's weak enough to justify rate cuts, but strong enough to show the economy isn't falling off a cliff. Investors will be paying close attention to non-farm payrolls, expected to come in roughly flat from last month. The unemployment rate, expected to tick up to 4.3%, and more importantly, no more surprise revisions. However, investors might welcome a reversal, regaining some of those lost jobs from last month. With the data so far, markets are feeling pretty good for that Goldilocks report. It would put a green check on the labor market with just inflation left next week ahead of the Fed meeting. So, what do you think? Is the job market weakening but resilient? Or is it crashing? Let us know.